Has Tesla finally bottomed after this 8-month decline? And is it time to pick up shares now that we are down almost 30% from the highs? Stick around to find out as we're talking about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to analyze Tesla's business and Q2 earnings results. The company is currently sitting at a market cap of $769 billion. And we're sitting at a PE ratio of 100, which is actually pretty steep for most growth stocks, but is actually a historical low for Tesla since they've achieved profitability. But we'll come back to that in just a minute. First, we'll discuss the financials, the top line, the bottom line, the margins, especially for the automotive segment, which have come in a bit since Q1. And finally, we'll conclude with a valuation of this business using our intrinsic value calculator to see whether or not this is something we as retail investors should add to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. So Tesla, a multinational automotive and clean energy company, they're doing extremely well, especially in the US and Canada, as they have amassed a mass amount of market share here. However, in Q2, and despite their record production rates across the company, they did have a slowdown due to their manufacturing challenges, and we'll see that in just a second once we get into the financials. But as you can see here from a delivery standpoint, we can see record deliveries this quarter once again, and that's followed by record free cash flow and record operating free cash flow. As you can see, their total production is actually up 25% year over year, despite being down slightly since this past quarter. They've also made significant increases to their deliveries, up 27%. But again, this is also down quarter over quarter. And again, this is also due to their supply chain challenges. You're going to see this a lot throughout this report, is that quarter over quarter, we haven't done so well. However, year over year, we've done a lot better. And this is a factor, again, of currency challenges, supply chains, and also economic headwinds. In terms of the revenue here, we've seen total growth of 42% year over year. This is due to their growth in vehicle deliveries, increased prices, so they are charging customers higher rates, and then their growth in other parts of their business. In terms of the profitability, again, we see those same things, but they've also lowered the stock-based compensation expense, which is actually a very good thing. Less money being rewarded for the management team and more money being rewarded to the shareholders. In terms of their drawdowns, we've seen higher raw material, commodity costs, etc. Higher costs in Shanghai due to their shutdowns. They were shut down for a good portion of the year as well in China. Negative Forex impact, which we just discussed, and Bitcoin impairment. Actually, what they've done with Bitcoin just in this quarter, they've actually converted 75% of all the Bitcoin that they had into cash. So they have absolutely liquidated most of their Bitcoin portfolio, and they actually acquired about $1 billion worth of cash, which they added to the balance sheet. Now, in terms of the financial summary here, we see automotive revenues came in at $14.6 billion, an increase again of 43% year over year. But if we look at this from the past few quarters, we can see that while we were on a nice uptrend, we've now seen a decline in Tesla, which is new for them. We've historically seen a lot of growth coming out of Tesla. And the same thing can be done with their automotive margins. Yeah, these have actually been increasing typically, but now we're down to 27.9%, which is actually good if you compare this to the industry as a whole. Now, on total revenues, despite people saying this is not just a car business, $14.6 billion worth of revenues is automotive. The remaining $2 billion, let's say, is from their other energy businesses. And altogether, when you add all the segments of the business up, we're at about 14.6% operating margin. And that leads us with the $2.2 billion worth of net income attributed to shareholders here for Tesla. And again, that is actually up 98% year over year. Down just quarter over quarter, but I guess you can't really complain if you're a Tesla shareholder, because if you're growing 98% year over year, I mean, you can't really complain at all. Earnings per share figures in and around this $2 figure, so keep that in mind when we get to our calculation towards the end of the video, and we'll get to the cash flows in just a second. First, I want to quickly look at the balance sheet here. We see cash equivalents of about $18 billion here, and they actually have debt of about, let's say, $3 to $4 billion worth. So a great balance sheet here for Tesla. Now onto the statement of cash flows for Tesla. Net income, again, we drag that figure down here, $2.2 billion. Add back in depreciation, amortization, stock-based comp, and we get to this operating free cash flow figure here of $2.3 billion. Deduct our capex figure here, and we're left with about $600 million of free cash flow that they can reward shareholders with. What did they do with it? They didn't actually get a chance to truly utilize this free cash flow. It is down and subdued. If we go back to our financial summary here, we can see free cash flows over the years have actually been growing quite well, and we've recently seen some declines now, and we're down to $620 million. for free cash flow. So what can you really do with that? Well, they're just trying to retire some debt right now, and they do have 18 billion of cash sitting on the sidelines that they can do acquisitions with, i.e. Twitter. Maybe they could even start buying back some debt. There's a bunch of different things they can do with the cash, and they can be as creative as they want to be with that. Now let's jump into our calculator here to see what price we could jump in here on Tesla. If you recall, we had about $1.95 in earnings per share this quarter. If we extrapolate that out, assuming there's going to be some economic hardship for this next year and the years to come, we can assume Tesla can get to about $8.5 in earnings per share for the year. And if we require a 10% return on our money, they're currently growing revenues at a staggering rate. So let's bump this up to 40% for the first 5 years and drop it down to, let's say, 20% for the 5 years after that. We have to be a little conservative here on a 20 PE. Yeah, the stock price should actually be worth about $804 per share. We're currently sitting at $742. So a decent upside there. And in the best case scenario, let's say we can actually continue to grow year over year at, what we just saw, 98%. Let's jump this up to about 70% for the first 5 years, because guys, this is a lot year over year. And then we'll drop it down to, let's say, 35% 5 years after that on a 25 PE. We could actually be worth a staggering $4,250 per share. Now that would be significant upside, and Cathie would actually be right in the end. However, if growth slows with Tesla, with their supply chain challenges, forex challenges, etc., and we see a decline down to a growth rate of about, let's say, 15% for the first 5 years, and then let's say it gets down to like 8% after that, or even lower, let's say 5%, just to see what the calculator can do for us on a 15 PE, the stock would be worth $132. So as you can see, it gets really ugly with Tesla if the growth slows or stops. And as you saw earlier, we are at about a PE of 100, which means the growth is really priced in. And that's really the risk with Tesla and investing in Tesla, is that they need to be able to continue to produce, and they need to be able to continue to sell and grow at these high rates. And if they can, the stock will appreciate quite handsomely. However, if the growth does slow, this PE ratio will not stay at 100. It will be lower, and that means the price will tank from there. With that being said, guys, that's the analysis for Tesla's Q2 earnings. If you've enjoyed this video, please leave a like and subscribe for more of this content. With that being said, I'll see you on the next one.